Hi folks, Chuck Gibson from Financial Perspectives. Today is the 6th of February, 2019. I wanted to put together a quick video providing my current read on the stock market. The entire video will focus solely on US stocks and the S&P 500 index. Let's get to it. The first chart is a daily look at the S&P 500. You can see it bottomed on Christmas Eve and has since rallied, retraced 62% of the decline. In retrospect, this strong showing should not be surprising. With mean reversion, which is exactly what this is, the further you get away from the mean, the faster and stronger the snapback. Using the red 200-day moving average as your mean proxy, you can see that by Christmas Eve, price had gotten as far away from the moving average either above or below as in the entirety of this whole chart. Adding a couple of illustrations, RSI momentum in the upper pane has transitioned from the bullish zone, that ranges from 40 to 80, instead to the bearish zone, which ranges from 20 to 60. Of course, with continued strength, this will probably move back into the bullish zone, but until it does, this is one for the bears. For a market to move higher, you need strong momentum. While the recent rally from December's low is impressive, drawing in the Fibonacci extensions, you can see we are approaching a confluence of resistance here as we near the 61.8% retracement level and are still under a flat 200-day moving average. Traders focus on shorter-term charts, while investors look at the long term, so I wanted to lengthen out the chart substantially to see what clues it might hold. This 20-year look at the S&P 500 can help filter out the noise of daily movement and help identify potential long-term directional changes. My next few charts are going to use the same longer-term look, but we'll be adding illustrations successively. First, adding in an uptrend line, it should be immediately noticeable and confirm what you already know, which is each past major decline started with a break of their long-term uptrend line. RSI momentum in the upper pane helps provide useful information about the strength of a trend. Adding in its notations highlights divergences, which can be an early warning of potential change in the direction of price, as momentum leads price. As you can see in 2000, momentum was falling while price continued to rise, signaling negative divergence. For math nuts, momentum is the second derivative, in this case, of price. It's sort of like climbing a hill in your car. You can eventually slow, stop, and reverse backwards if you don't increase the amount of gas provided to the engine. The same thing holds true for stock uptrends, but instead of gas, the momentum fuel is buyers. And not just any buyer, but institutional buyers as they hold large sums of money which can move markets. Looking further right, the same thing happened in 2007-2008. Momentum diverged with price, and eventually price crashed. No need to mention what has already happened at the end of the last year. Finally, I added in some horizontal lines to illustrate that besides momentum divergence and a break of the long-term uptrend, price eventually began to form lower highs and lower lows. While it can take a long time for it to become obvious, this is your signal that the high probability the past uptrend has reversed course. In 2000, each successive high and low was followed by a lower one. The same thing occurred in 2008. Fast forward to today, you can see we have only formed one higher low. As of now, this does not yet signal a change in direction. Clearly, going forward, if the next high that we make is lower, the probability is the top is in and the end of this bull market is over. I have to be clear that if it turns out to be true, it doesn't mean we will see another 50% market decline like we did in 2000 and 2008. We might, but we don't have to. It could be something less. The problem is, of course, we just don't know. No one does. This is the risk that you need as an investor to determine if you're willing to take. You know where I stand. Keeping a longer-term perspective, but changing the chart to include only the last 10 years rather than 24 to improve granularity, the current environment becomes a little clearer. To summarize, we have a break of the long-term uptrend line. Price currently sits under a flattish 200-day moving average. We have bearish momentum with the current high and one low being formed. Using a weight of the evidence approach, as of the time of this review, the majority of the evidence is not long-term bullish, and why I continue to lean conservative and cautious in my view of stocks for client portfolio. For those thinking it must be time to go short and expect more downside, that's always a possibility, but there is not enough evidence yet. Let's zoom in on what happened in 2015 and why all these bearish signals may end up being wrong. Back in 2015, and without the advantage of hindsight like we have now, the index followed the same path we're currently on. As it broke below its dotted uptrend line, it had bearish RSI momentum divergence, and then went on to make one lower high and two lower lows. This is normally everything you want to see before you throw in the towel, sell all your stocks, and then pile in short. But we know what eventually happened. Instead of breaking down, it moved higher. In fact, strongly higher after an 18-month sideways consolidation. Trust me, this caught a lot of professionals off guard, as the expectation was that the bull run had ended. The takeaway of this video is that there's no certainty, no guarantees, and risks exist no matter what course of action you take. In the case of 2015, all the indicators were aligned pointing in one direction, which we all know in hindsight turned out to be wrong. Because no one knows what the future holds, and analyzing the past to predict the future only provides an increase in probabilities, never a guarantee. So what's an investor to do? Well, the only approach that works is to use a weight of the evidence and have a plan B in case you turn out to be wrong. As I continue to preach, with random markets, being wrong is okay and very normal, but staying wrong is not. My take here right now is as of the date of this video is US stocks are stuck in this bigger range. As such, investors, we need to be open and prepared for either of the two possible outcomes of either breaking out to new all-time highs or a much greater decline in stock prices. Until the time comes when the market tells us what it's going to do, it never makes sense to go ahead and take action in the middle of range, as the risk to reward of doing anything, other than a short-term trade of course, is 1-to-1, which is not a profitable strategy in the long run. Before I wrap this up, I want to remind again that this video is addressing only the broad US stock markets. There are a number of other areas that are perking up and becoming of interest. Precious metals and foreign equities are two examples that immediately come to mind. With a wide investment net, the good news is there's always a bull market going on somewhere. Well, that's it for now. Thanks for listening. I look forward to your comments and any ideas you may have for future topics of interest. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening.